Sir, please start.
Okay. So dear students, now sorry for the delay. The delay was because of some technical issues. So today I'll be talking about a very important topic for the accountants. Now you people will be qualified accountants after you pass this course. Therefore, you need to know essentially when you are learning company law. Essentially, you should know that what is the provisions under the Companies Act so far accounts, audit, and dividend is concerned. Accounts, audit, and dividend are studied as a single chapter because they are interrelated. Now, the first thing is that whenever a company makes a accounts, this is for the statutory purpose because as per the company law, all companies, whether they're incurring loss or profit or doing business or doing very less business or not doing business, have to maintain their accounts. But assuming that it is not a company, the question is why a business should keep the accounts. Is it necessary for any business unit to keep the accounts? Is it mandatory to keep accounts? The answer is there in the Income Tax Act. In the Income Tax Act, it stipulates the situation when a business unit has to keep account. Now, as you can see on the screen that if the income of the business or profession exceeds 1.2 lakhs in 3 preceding years, or the total sales or turnover or gross receipts exceeds 25 lakhs in any of the 3 preceding financial years, then that business unit has to keep account. Now, why these accounts? The income tax may any time ask for the accounts which you have to show once you are under the scrutiny. Now, the question is it necessary for the accounts to be audited? Again, the answer is there under the Income Tax Act, which says that in case of business, if the total sales, turnover, or gross receipts are more than 1 crore and 10 crores if 95% transaction is through banks, in that case, audit will be compulsory. In case of the professionals, practicing cost accountants, chartered accountants, CS, lawyers, in such case, your audit has to be compulsory audited if the gross receipt is more than 50 lakhs. So these are the stipulations of the income tax for which mandatorily you have to keep some account. But if it is a company, any type of company, you have to keep the accounts. Whether you are making profit or loss. Now the question is, what do you mean by account? And what do you mean by books of account? The accounts is a record of financial transaction. Or you can say accounts is the record of transaction because all transactions are in a business is a monetary transaction. Of course, there can be some non-monetary transactions. So to make the things very clear, let us define accounts as recording of financial transactions. Now, when you say recording, that means that it is recording the event which has already happened. It is recording a transaction which has already happened. So therefore, accounts are always historical. Accounts are always historical. And this is called financial account. Financial account is always historical because it records the facts which have already happened. Now, company accounts provide for financial accounting. When you say statutory accounts, it is basically financial accounting and it is audited by the statutory auditor. Why statutory auditor? Because the audit is compulsory under a particular statute, that is law. So, books of accounts, every company shall prepare and keep at its registered office book of accounts and other relevant books and papers and financial statement for every year. What it says that the uh, every company, any kind of company, they shall prepare them and keep at the registered office of the company Maybe the head office is somewhere, but corporate office is somewhere, but they have to keep it in the registered office. Other relevant books and papers, that is also defined what is relevant books or papers. They are basically those documents which support the accounts, which support the financial transaction. And financial statement for every financial year. So any kind of financial statement has to be kept in the registered office. And these books of accounts should have true and fair view of the state of affairs of the company, including that of its branch offices or offices. So if the company is having any branch, the consolidated accounts, summarized accounts should be available in the head office, and if to show the true and fair view of the state of affairs, that means it should be totally factual as to what has happened, what financial transaction has taken place in the company. And it should explain the transaction. So all of you know that you are all of you are in the final of scores, and you must be aware of something called voucher. What is a voucher? Voucher is recording of a financial transaction. Now, when you talk of financial transaction, the money will come to the company and money will go out from the company. So money is coming to the company, we call it credit voucher or receipt voucher. When the money is going out of the company, we say it is a payment voucher or debit voucher. So there are basically two types of transactions. Money will come to you, money will go out of you. But there's another kind of transaction where you make inter-accounts adjustment. Adjustment between one account with the other account. That is what we call journal voucher. Journal voucher is a voucher where funds are transferred from one account to other account in the same company. So this is about recording of the transaction. Now, what it says, explain the transaction affected both at the registered office and its branches. Explain the transaction. What does it mean? All of you must be aware of something called narration. And if you see a voucher, you will find that payment to so much against this. So one is debit. If you are debiting somebody, some account has to be credited. And there is a space provided down below, and there are some blank lines where you have to give the narration. This narration will tell you what is the purpose of the expenditure and why this expenditure and who has approved this expenditure. Okay, why you are making. So we say that, let us say there is a payment for purchase of 50 chairs. So much paid to Godrej and Company for purchase of 50 chairs as per their invoice dated this, and then you say approved by maybe CMD or MD or anybody, GM, why dated this, why this note. So all these documents you put along with the voucher. So that is explaining the transaction. That is very important. Now, what is audit? When you go for audit, audit will ask for the explanation of each of the transactions. What is this transaction? Why you have made it? You have paid to this place. What is the author? Where is the authority of payment? So this is called explanation of the transaction. Now, very important is the books of accounts shall be kept on accrual basis. Now, see, here a new thing has come, that is accrual basis. So accrual basis and due basis, the difference is in payment basis. In case of payment basis or cash basis, or we call it mercantile basis, what happens is that whatever money is being paid is considered to be your expenditure, and whatever money is received is considered to be your income. So this is the concept of mercantile. Small business people, how they determine their profit, they will consider all payments made as their expenditure, and whatever money has come to them or whatever source, they will consider this as their income, and the difference will be their profit. So this is the traditional mode of keeping accounts, which for mercantile basis, or it is also called cash basis. But under the Companies Act, you have to keep accounts on accrual basis. Now let me explain what is accrual basis. See, when you make accounts of a company, the accounts relate to a particular period. The accounts relate to a particular period. Normally the period is 1 year. You can make a smaller account, that is quarterly account, but normally financial statement is made for the whole year, and that year is considered to be accounting year. Now, before the enactment of Companies Act 2013, the companies had the option to select their own accounting year. So some of the companies they selected July to June, some of the companies selected January to December as their accounting year. This was allowed. But now, with the new act, all companies have to maintain their accounts on April to March basis. April to March basis is the government financial year, and April to March is the financial year which is recognized by the income tax. Income tax never recognized any other financial year or accounting year. So what these people used to do earlier, they will make two set of financial statement. One, maybe if they are following, let us say January to December, they will make one account from January to December, and the other account they will make from April to March to satisfy the income tax authority and to determine the profit of the company. So companies used to make two sets of accounts who are not following the accounting year. But now, since the uniform accounting year has been made, the company need not make another financial statement. So this is so far the accounting year is concerned. Now the question of accrual. Accrual basically means that you have to take the income of that period only, and you have to take expenditure of that period only. That period means relating to that period. Relating to that period. I'll just take you two examples. One for receipt, one for payment. Now let's say there are a lot of bills which relate to expenditure for the month of March. You do not get the bill on March. You get the bill in the month of April. And if you get the bill in the month of April, you will pay in the month of April. But your accounts are closing on 31st March. So what do you do in that case? If you don't include those expenditures which relate to March, you don't include that expenditure in your accounts, which is up to 31st March, then your accounts are showing a wrong figure. But you don't have the bills. So what is practically done? The step one is that most of the companies say that whatever expenditure is making for the month of March, please give us the bill within 31st March so that we can pay you and record in the account. But still there are certain bills like, maybe your telephone bill or electricity bill, you may not get on 31st March. But your consumption up to 31st March has to be taken care of. So what happens, they will give you in the bill, let us say in the month, on 15th of April. So you have to pay on 15th of April. But while making your financial statement up to 31st March, what you do is, whatever the companies are supposed to do, they will make a list of those payments which are due, which they could not pay within 31st March, but they relate to the period up to 31st March. So in that case, what is to be done? They will make an account saying that liability for expenses or outstanding expenses, and they will put that liability, that expenditure, in the balance sheet so that it is accounted for in the balance sheet, because it is related to a particular period. In the same way, let us assume that the company has taken 3 years AMC, annual maintenance contract, for the AC machines. Let us say company is having 32 AC machines in the company, and they have taken AMC for 3 years, annual maintenance contract for 3 years, and they paid 3 lakhs. The question is, can they book 3 lakhs in the year which they have paid? Answer is no, because they do not relate to 1 year, they relate to 3 years. So they have to proportionately allocate that expenditure in a particular year, because the expenditure relate to that particular year. This is the concept of accrual basis of account. Relates to a particular period. And the second stipulation is that you have to follow double entry system of account. Double entry means for every debit there will be a credit, and for every credit there will be a debit. So what happens in closing down the accounts? When the accounts are closed, some account will show a debit balance, and some of the accounts will show you credit balance. If your entries are correct, if your entries are correct, you can jolly well understand that total debit and total credit will be same. Total debit and total credit will be same because every debit has a corresponding credit and every credit has a corresponding debit. Assuming that your entries are correct, the total debit figure and total credit figure will be same. And this is determined through a statement which is called trial balance. You must have heard of trial balance. If you take a trial balance up to 31st March, which shows the balance of various types of accounts in the company, you can make your profit and loss account and balance it from the trial balance with some adjustments. So this is the concept of double entry system and accrual basis of accounting. Any questions, anybody, till now? Okay. Now the next thing, where you keep the account? Accounts are supposed to be kept at the registered office, as I told you earlier, but the board of directors take a resolution that the account shall be kept in some other place, and they have to give a notice to the register. Now there are some companies like see Britannia Industries having the registered office in Calcutta, but the corporate office is in Bangalore. So all their basic documents are in Bangalore only. For that, they have taken the approval of the board and they have filed with the registrar. So you can keep in other places also. Primarily, you are supposed to keep in the registered office. But supposing if for certain reason you are not keeping it with the registered office, you can keep at other places also with the approval of the board, which has to be filed with the registrar of company. The last point is that you can keep accounts in electronic mode. So there is a very big and essential thing which has been done by the government for the companies to keep the accounts in electronic form. And that is the reason, now you will find that the accounts are made with ready very quickly. The accounts for 31st March, maybe you can get the accounts of some of the company in the first week of April. Because most of the entries are already made on the real-time basis. And there are various accounting softwares available, and there are customized softwares also. And there are some systems developed by each of the companies to keep the accounts. So, in like our manual accounts, it used to take a lot of time first to balance the account and make manual schedules. But now those problem is not there. And secondly, accuracy. So company may also keep books of accounts and other relevant papers in electronic mode. Now, supposing the company is keeping electronic mode, there are certain stipulations which you have to see. I'll come to that. But before that, let us understand that what is the format of account. Now, see, we've got more than 30 lakh companies in India, and all these 30 lakh companies has to present their accounts in a uniform format, and that is the purpose of the law. Why uniform format? Because the outsider, whether an investor or any other person, even the shareholder, should be able to compare between one company and the other company. And if there is no format, just imagine 13 lakh companies choosing their own format and submitting the account. It will be total mess. So what the government has done or the law has said that Schedule 13 to the Companies Act is the format of your financial statement. So what we have in financial statement, we've got profit and loss account, and we've got balance sheet, which is also got sources and application of funds, and we have got cash flow statement. So these are the three financial statements which are supposed to be made at the close of the financial year. Now the format of this particular accounts is little bit different in case of three kinds of company, that is insurance company, banking company, and company engaged in generation and supply of electricity. Now why this is there? See, these companies are called sectoral companies. So they belong to a particular sector. So one is insurance sector, other in banking sector, and the other in electricity sector. More so, there are separate laws, like insurance companies regulated by Insurance Act. The banking companies are regulated by Banking Regulation Act. The electricity companies are regulated by Electricity Act. Under the Act, the method of presenting the accounts is mentioned, and therefore the format is different. So insurance, banking, and electricity company has their own format of presentation of the annual account. Now, what the accounts are made, what happens? It is supposed to be laid before the annual general meeting. So I'll tell you the procedure, what happens in practically. Moment the year is closed, 31st March, the job of the accounts department to close the account. Close the account means that as on 31st March, they will try to know the balance. So if the debit is more, it will give a debit balance. If the credit is more, it will give a credit balance. So they will take out the balances on the 31st March. That is the job one. After that, they will prepare the account, profit and loss account, balance sheet, and cash flow statement, and they will see the adjustment. After these accounts are made, this will be placed before the board of directors for their approval. Once board of directors approve this account, which they will sign, they can sign only after the board meeting. And the board meeting agreed to the accounts, they will sign, and after they sign, it will go to the auditor for audit of the account. But in practice, what happens? Both preparation of the accounts and audit goes side by side. Because supposing that the board of directors makes an account and finalize the accounts in the month of July or June, and in the month of June they give it to the auditors to audit, or in the month of July, the auditor will take his time. So there is shortage of time. Why there is shortage of time? Because it has to be placed before the annual general meeting within 31st September. That means the company has 6 months time to present in the annual general meeting and get the accounts approved. This is not called approved, this is called adopted by the shareholder. More so, they have to give a 25 days notice. So the latest date of notice to the shareholders is 6th of September. By 6th of September, notice should go. So by 6th of September, the company has to send what to the shareholders? Company has to send the three accounts, as I told you: profit and loss account, balance sheet, and cash flow account. They have to all audit it. After audit, they have to send the notice of the meeting along with ordinary business and special business. They have to send the auditor's report, and they have to send the report of the board of directors. Now all these documents are supposed to go to the shareholder. The latest date of the last date of doing AGM is 30th September. You can do before, but you cannot do more after 31st December, for which you need to take special permission of the register of company. So this is the steps after 31st March for preparation and getting the accounts approved by the shareholder. Now, a new thing which has come, that is called consolidated financial statement. Consolidated financial statement, for which, for the subsidiary company or associate company. Now see, what was the rule earlier? That all the documents, the director's report, accounts, cash flow statement, everything, auditor's report, everything has to be attached to the accounts of the or the annual report of the holding company. All these documents. Now there are some companies like ICICI and Steel Authority. At one point of time, these companies had 7, 8 subsidiaries. So just imagine the original is there of the main company, holding company, and after that, the accounts and all the documents, directors report, everything of 7 companies are also attached. And imagine the size of the annual report. Imagine the size of the annual report. So this was creating a lot of operational problems. And the second problem was that the audit of all these companies need to be done before the audit of the holding company. So government solved the problem by introducing something called consolidated financial statement. Now you need not give all the documents. So what you need to do, you have to just do an account where the figures of the subsidiary company also will be added or adjusted. What will happen in case of a holding company? In case of a holding company, the accounts, this is called standalone. Standalone accounts of the holding company will be there, and there will be a consolidated financial statement where all the figures of the subsidiary company, if there is one subsidiary, no problem. If there is more than one, all the figures will be put in that particular financial statement, and this will give a consolidated financial statement of which company? Group company, subsidiaries or associate company. So this is the concept of consolidated financial statement. You people might have seen that in the paper also. Now it is there coming out the Q2 results. Results up to September quarter is coming out. And if you see the results in the paper, they are coming in a particular format which has been developed by SEBI and which applies to all stock exchanges in India. And this is having certain figures, not all the figures. Now, the idea is that shareholders should be able to see the performance of the company every quarter, shareholder or any other investor, so he can take investment decision. And why it is in the same format? Because shareholders should be able to compare on like-to-like basis. Supposing an investor or a shareholder wants to invest in IT company, we can just take the figures of Infosys, TCS, CTS, or any other company, take Mahindra, side by side, and compare the figures very easily. That is the purpose of the consolidated financial statement, which is, published in a paper every quarter, and also the annual results in a particular format, so that they can compare in like-to-like basis. So this is the concept of consolidated financial statement. Now the question is, once you make the account, who is going to authenticate? Who is going to tell that this is the real account? Now the procedure is, once the account is made, it will be placed before the board of directors meeting. When majority of the board of directors agree to the account, that yes, this is the accounts we are looking for and this is okay, they will authorize people to sign that particular document. Who are the people going to sign that account? By the chairperson of the company. Again, 2 directors, out of which one shall be managing director. The managing director is one in the company, so there is no option. He will sign. But supposing there are many directors, so 2 of the directors will be signed, will be authorized by the company in board meeting. Who else? The CEO, The CEO can be chairman or can be the MD. Managing director also can be CEO. By default, MD is the CEO of the company. But there are companies, some companies, I told you in the previous lectures, that there are certain companies, the chairman is full time. So the CEO is the chairman. Take the case of LIC, State Bank, Steel Authority of India. The chairman is full time, so he is the chief executive. There may be MD, but the MD may not be the chief executive. Even we grow. So this is the concept of CEO. So they will sign, and CFO will sign. Chief Financial Officer will sign the accounts, and the company secretary of the company, they will sign. And once they sign, your accounts is considered to be authentic. That means yes, this is the account which has been ultimately finalized. If it is not signed, that means there can be some changes take place anytime. Sometimes auditors say that we won't work or we don't give our statement, auditor's report, unless I get a signed copy of accounts by the directors and executives of the company. So auditor wants an authenticated copy. Once it gets an authenticated copy which is signed by the directors, the auditor will also sign that account. Before that, auditor may refuse to sign them. May refuse. This is called authentications of the financial. We proceed next and let us try to understand that what do you do after that? What do you do after that? You make the accounts, get the approval of the board, and that you go to the shareholder in the annual general meeting. And to whom it is sent to all the members, that is shareholders. The accounts and notice of the meeting is also sent to every trustee for the debenture holder. I've explained what the debenture holder is and what is a debenture trustee in yesterday's class. So they'll be there, and to all other persons except such members and trustees. To all other persons means people who are entitled to get. There is the directors of the company, auditors. They also supposed to get the copy of the notice and the financial statement. Now there is a liberalized policy for the listed company where it says, the law says, that in listed company, these documents need not be sent to every shareholder because there may be few thousand lakhs of shareholders in a company. What they will do, they'll put a copy in the website and they will mention that the documents are lying in the registered office of the company. Any person interested can come and inspect the document. So people can come and themselves inspect the document, which are supposed to be sent to them. And they have to put it in the website. We proceed to the next step. It goes to the shareholder, fine. Situation one is that it is adopted by the shareholder. Situation one. So what is adopted by the majority of the shareholders means this account is adopted in AGM and this is final. So this resolution and the consolidated financial statement or the financial statement of the standalone company, they will be filed with the register within 30 days of the date of AGM. This is a clean case where the accounts are adopted. Situation 2, accounts are not adopted. Place the accounts in AGM. Put the AGM, but the shareholders say no, we don't agree to this account. What you need to do here? Here also you have to file with the register within 30 days of the date of AGM, and the register will take this as a provisional. So what will be done? The directors may again make a separate account, again circulate it to the shareholders and get the approval of the shareholders. And thereafter they can file the revised accounts to the registrar of companies. This is situation 2. There can be again a typical situation where the AGM has not been held for some reason, but the financial statements are made and they are signed. But for some reason, AGM could not be held. Here, the law is that whether there is AGM or not, the account shall be filed with the register of company within 30 days of the last date before which AGM should have been held. So this date is 30th March, 30th September. So supposing for some reason the company could not hold the AGM, they have to file the annual account unadopted. Unadopted, what? There's no question of adoption because the AGM is not taken place. Within 30 days of the last date of AGM, that is 30th November. So these are the, in very short, legal provisions under the Companies Act relating to accounts of companies. If anybody has any question, please ask me here. Students, are you audible? I can see only 3 students here: Madhumita, Ashish Tiwari, and Archana. Are you there in the class, students? Can you give your consent? Anyway, so we'll proceed now with audit, appointment of auditor, and thereafter. But I think we can take 5 minutes break here, and then I will proceed for the next part of this PPT. Okay, now I'll be talking about auditors. Now, all of you know what is audit and how audit takes place. So first we'll talk of who can be auditors. Obviously, these are statutory audits. Only chartered accountants practicing can be auditors. Now, when they say practicing, they will be having a firm, maybe proprietorship firm, it can be partnership firm. So when the company starts, the board of directors will appoint the auditor for the first time. That is within 30 days. But this auditor will continue to the first annual general meeting. Auditor is supposed to be appointed by the shareholders. So in the first annual general meeting of the company, auditors will be appointed. But during that interim period, excuse me for some time. Uh, uh, ಅದು ಪಟೇಲ್ ಮಾಡಬೇಕು ಈಗ yeah. So this is how the first auditors are appointed. In the first annual general meeting, the shareholders can appoint any other person or the same auditor can be appointed by the shareholders. Now, an auditor can be appointed for 5 years at a time. If it's a proprietorship firm, that is only one chartered accountant having a firm, that CA can be appointed for 5 years at a time. And if it is a firm of partnership, then they can be appointed for 2 terms of 5 years each. So this is what is the present law on appointment of auditors. As I told you, the first auditors will be appointed in 30 days. But supposing the board fails to make a appointment, the appointment shall be made by the shareholders in the first annual general meeting of the company. And within 30 days from the recommendation of the board, and auditors should hold their office up to conclusion of the next annual general meeting. Now, this particular provision now do not apply. If the company is appointing for 5 years at a time, then this provision will not apply. But if the company is not appointing auditors for 5 years, then auditor has to be appointed every year. Now there are certain automatic appointment means if it is disqualified, then he cannot be auditor. And there are a lot of disqualifications we are not talking here. We'll come to it maybe a little later. So auditor is not agreeing to continue as an auditor. And the next is a special user has been passed.